Welcome to the daily update, where I'll go over the action in the market for Friday, July 5th, and we'll see how things look for Monday, July 8th. Another day, another all-time high, another day with the bigger large cap stocks really leading the march higher. We're not seeing an awful lot of internal strength in the S&P right now. In fact, we're seeing those negative divergences, which still continue to go on. But as I always say, price is the ultimate indicator, and we have to go with that. But we're keeping an eye on the things that are happening under the surface of the S&P 500, because if we start to see a decline of any significance, these negative divergences may really come into play. But for right now, on a trending basis, we're looking pretty solid across all the different time frames. One thing that is creeping into the market now, and actually it's been kind of building for a while, is this concern about economic weakness. The employment situation report came out and it was weaker than expected. The unemployment number, which I don't really pay attention to, that's so manipulated, and you can't whittle everything in the US economy down to one number or even just a series of numbers. You have to really look at what's going on. But it's what the media will fixate on. It's what politicians will fixate on, either from a positive or negative stance. It's kind of hard to swing this one in a positive way, given what's happening politically right now in the US. There's also a lot of things going on in the UK. They just had an election. There's a continuation of an election over this weekend in France. And there's a lot of stirring going on that could eventually work its way over into the markets. But in Friday's session, it looked like everything was just looking fine. Everybody had a good 4th of July, and they wanted to buy some stocks on July 5th. I do have a thing called the SPXInvesting Program. I haven't quite been able to lock that down yet. There's some kind of logistical reasons for that. But so it's wide open for right now, and it's still free. I had planned on actually starting the membership process in July. I'm pushing that back a little bit for right now. I'm including some additional videos. These are position ideas that you may consider, and it was a really good week for the program. I ended up having 6 positions that were opened, and 4 of those ended up closing for a really nice profit in Friday's session. But if you want to tackle into some of those things and see the kinds of strategies that I'm implementing and more videos that I'll be producing down the line, please feel free to check that out. The daily video is accessible to members of the program right when I produce that, and where the public version of it doesn't become available until the market closes for that particular day. For example, this is for Monday's session. It won't become public until we close on Monday, but I'm recording this Saturday morning, and it'll be available to members throughout the whole weekend. So that's one of the benefits you get of looking at being a member in the program. There are links to get you to the website in the description below this video. There's also links to other videos that talk about the program. And if you want to have a conversation with me, here's an email address. We can go back and forth with email. We can set up a time to have a chat back and forth, or even a video conference if that's something that is of interest to you. Also, since I post a number of different videos, every once in a while I get folks that come along and say, okay, well, this video was great, but what does it have to do with anything? That's because all of these videos are treated as one unit together. And that really points to this video, the daily video. All of the weekly videos that I do and the supplemental videos that I do, they tie into the daily video. That's the real foundation and benchmark. So if you're running across any of these videos, and I'm going to be saying this in all the videos, at least for the next few weeks, that you're a little bit confused, it's like, okay, where does this fit into the bigger picture? Well, to me, the bigger picture is the smaller picture, which is the daily video update. Okay, let's go back and talk about what happened, and then we'll go through some charts. We did have a higher open. The futures were positive. There was a little gyration going on. The initial reaction to the employment situation report was positive, and then they kind of thought about it a little bit and went, okay. And really, there wasn't much of a reaction to it, but we did end up having a higher open, and we hit resistance pretty much right after the open at R1 at 55.48. We fell back down to the unchanged level. There really wasn't a gap to fill in Friday's session, but that unchanged level will quite often act as support on an up day. It can also act as resistance on a down day, and that's pretty much what it served on Friday, was an act of support. Then from there, prices resumed rising. So we started to go back up. We got back above R1. So we didn't hit that resistance level again. We were able to break through that. We got up to R2 at 55.60, and we actually broke above that. Now, we didn't get to R3, so I didn't put that on the chart, but we closed almost at the high for the day. Some of this, yeah, could be attributed to short covering. You've got a lot of folks that are looking at what they're seeing in the market right now and setting themselves up for things to fall, but prices keep going up. And I can see the logic behind that. They're just trying to front run price. And that can really catch you sometimes when all of a sudden we're going up and these short positions that are in the market, they have to close those out by buying, and that can help push prices even higher. So we were up 0.54%. No, we really haven't had that big of a climb here. We have been able to break out above this range to this point that we've been in for about a week. We closed above that on Wednesday, and then we were able to break further above that in Friday's session, but we're not seeing any real huge moves at this point. 0.5% here, maybe a little bit over 0.5%, sometimes under 0.5%. These aren't really big moves that we're used to seeing, but we were below average with volume. Probably a lot of folks were nursing the National Hangover Day as they celebrated a little too much on Thursday, and just it turns it into a 4-day weekend. It's kind of like Thanksgiving, but we are positive in the short, intermediate, and long term. And in Friday's session, it was about the employment situation, and interest rates fell because of that, and that helped push stocks higher. In the upcoming week, we're going to get CPI and PPI in Thursday and Friday session. So right around the corner is going to be coming some more inflation information. We want to be aware of the geopolitical things, not only in the US, but what is happening on the political front throughout Europe. And then, of course, there's all of this other geopolitical things happening between Russia, Ukraine, and in the Middle East that at any time could really erupt and have an impact on the markets. Some comments. Yet again, the NASDAQ 100, the NASDAQ, and S&P 500 closed at new all-time highs. It was the mega caps coming through. We've got a lot of those stocks that are doing well right now, and that's what's really pushing the indexes higher. The employment situation showed that there's possible economic weakness that's developing. This report was weaker than expected. Now, you may say we've been going through a period where bad news is good news. Yeah, and that's true. And that's why we went up on Friday and interest rates fell. But too much of this could end up being, okay, bad news is now bad news. We're just waiting to see if that shift is going to take place. About a month ago, it looked like that shift was happening, but then we went back over into our old way of good news is bad news is good news. That's why we watch these things so closely, to try to get a feel for how the market's reading these things. We're getting a little bit longer list here in the short term. We have the Stochk RSI, which, my goodness, we had one down day and it was extreme negative. Now it's back to being extreme positive. The Williams percent are the CCI 14 and 20, the stochastics. The boom indicator's now on here again. That was not on after Wednesday. We're getting a little far away from that 20-period moving average, and then our shorter-term RSI based on 9 periods. In the intermediate term, a new addition is the balance of power. It's right on that black line, and I'll show you that chart. The CMB composite is also starting to get extreme positive, and there's a new way that I'm measuring the accumulation distribution chart that I'll show you, and we're getting kind of far away there as well. But we're not seeing really across-the-board strength with our smart money indicators, and I'll talk about that. The standard deviations chart, we're in that +3 channel. We've been there for a couple of sessions now. The Sean trend meter, the boom, based on 50 periods, we are getting kind of far away from that 50-period moving average. And the RSI 14, which has been on the list for a couple of days. The scenario really hasn't changed, but the market seems to be a little bit more convicted that there could be a rate cut in September. And I'll be going over that in the weekly video when I go through the probabilities chart of what's the Fed going to do. The dollar was down and interest rates were down. We closed at 4.27% for the 10-year yield, where we had been at 4.35%. We're still inverted with the yield curves. I look at those charts every day and they're not really moving. They're pretty much chopping sideways. We're not necessarily coming back to the point of getting back to a normal situation. But this has gone on for over 2 years now, especially with the 10 to the 2 year. This seems like the normal situation, but it's really not. Sentiment really bumped up. There probably was a lot of hedging ahead of July 4th, just because the market was closed and weird things can sometimes happen, or at least folks anticipate that things will happen. So a lot of that really helped sentiment in Friday's session. We're still neutral, but we rose from 44 to 54, and that's a pretty big jump on a sentiment basis. We are in a confirmed trend. That trend is positive. We're above 20. We're getting a little extreme in the short term, just something we want to keep an eye on. We're still looking pretty solid in the intermediate term. Because we had another up day, the bias is positive. I'm keeping our momentum at mixed, but you could probably change that over to positive. This is really the only subjective part that I put into the video, is bias and momentum. Everything else I try to be really objective about and let the charts speak for themselves. All right, the reports that came out, non-farm payrolls came in at 206,000. They expected 185,000, so that was greater than expected. But the number that really caught the market's eye was we had the last reading at 272,000, and they really revised it down to 218,000. That's a bit of a shocker to the market. And then the non-farm private payrolls, they did come in weaker than expected at 136,000. They expected 160,000. And they also revised this down from 229,000 to 193,000. This is what's concerning the market right now, are those revisions. The average hourly earnings came in as expected, up 0.3%, down from the 0.4%. And the unemployment rate, this is the headline number, it came in at 4.1%, the highest in 90,000 years, as people like to try to compare things. They expected it to come in at 4%, which is what we saw last time. The average work week did not change. My goodness, I would love to only work 34.3 hours a week, which is what they expected and what we saw last time. Here are some charts. Now, I don't show the job numbers because of the skew back in 2020. The charts are useless. So I just break out to the next chart, which is the hourly earnings on a year-over-year basis, which are declining. Now, you could take this as good news that that's not inflationary. Well, too much of this, and that could be, wait a minute, these folks aren't going to be out spending money. That could hurt retail sales. That could hurt the economy. That could suggest that we're in a slowdown. So we want to keep an eye on the balance between what's good and what's negative. Then the non-farm payroll change, we're looking this on a seasonally adjusted basis, where it did come in lower than what we saw last time. Here's the unemployment rate coming in at 4.1%, the highest in 20,000 years. And then just to compare this, we have the initial jobless claims and continuing claims, that's red and blue respectively. And then we are ticking up with the unemployment rate. So looking at this a little more in an easier way to see this, we're going up with these things, and that's suggesting a possible weakness in the employment situation. We have unemployment going up, which again, I don't really pay that much of attention to, but still there are people that do. We have the continuing claims going back up, and we're seeing a tick back up, and not on here, but the moving average of the initial claims are also going higher. Then some Isabel Net block charts. The rise in the relative size of the U.S. equity market has reflected the dominance of the U.S. economy. Yeah, we've got the biggest stock market in the whole world, and it's just pretty much reflected in this chart. Then corporate client buybacks, they're above the S&P 500 buyback trends. We're seeing a lot of buybacks right now, and that's typically what happens in a more positive environment. And then equity risk premia. Okay, what is that? The multiple of premium. Okay, just looking at these charts, and we mainly focus on the dark blue line here, they're just not seeing an awful lot of risk in the market right now. With the U.S. market being the less riskiest. So on a relative basis, there are other markets that are showing some risk, but but they are higher than what we're seeing in the US. And this is interesting. Inflation is politically toxic, where we're seeing inflation going up here, and that didn't have as much of an impact. Of course, the 2020 election was really strange with the lockdowns and everything, but this is really starting to come into an issue because no matter what you hear in the media, no matter how good the stock market is doing, and people are positive about that because they have their retirement funds, but they're just trying to put the next meal on the table or trying to get their car filled with gas or trying to have a 4th of July barbecue that doesn't end up taking out a third mortgage or something. And it comes down to the economy with US voters. And if the economy is starting to see some signs of weakness, now shifting over into the employment situation, this could really help bring down the approval rating even more than where it's already at. All right. And then the government, it's the world's third largest economy. Yes. Some people think, yeah, it's the way it should be. The government needs to try to fix all of our problems and have programs to help everybody. And other people say, no, the government's job is just to be barely strong enough to survive, and their job is to protect us. Let us do all the other stuff, leave the government out. And other people say, no, the government, we're a benevolent society. We need to help people that need help. So, but that's really where we're headed with all this continuation of these government programs, and there's 4 or 5 times overlay of the same programs trying to do the same thing. And that just leads to the US government being a big economy in and of itself. Then speculative mood, Bitcoin, which has really been under pressure. It's actually breaking further below. It got down to 55,000, 54,000 or so. And then you compare that to the NASDAQ, where there's kind of a loose connection between the two, but we're seeing a real divergence right now. Not sure which one's going to give first in this whole scenario. If there is, I don't really track the relationship between the two, but you can clearly see that there is one here, and want to see which one's going to snap more back into line if this relationship continues. I didn't find anything other than this, and this wasn't even on Twitter. This is one of the perma-bear folks that I've been following for decades. I don't give the name because this person is very sue happy, and if you say anything against them, they threaten to take you to court and all this other stuff. That's a lot of time what perma-bears will do, even though what they say is 70% wrong. But this is a quote coming out saying, several bodies of technical analysis are converging into one cohesive forecast for the stock market. They are telling us a significant trend turn is imminent. No, it's not. It doesn't turn until it turns. We are seeing the weakness. We're seeing these convergences of negative divergences coming together, but it doesn't mean anything is imminent. That stocks should find themselves in a new declining trend starting within a few weeks. Well, what does that mean? We're looking at tomorrow. We want to know what's going to happen on Monday. We can project anything we want weeks out into the future. Anybody can come up with anything. So that's pretty much a useless statement, and one that lasts for several months. How do you know that? I mean, this could end up happening, but we're not seeing any evidence of the first part of this statement. Why should we take anything in the second part of this statement as legitimate? That's what makes me angry about these people, is no matter, here we're hitting all-time highs, and you've got these perma-bears saying we're about ready to fall apart. Now, that could happen, but look at the charts, okay? And then here it comes up with some more false information, basically. There is a confirmed Hindenburg omen. No, it's not. We saw a bunch of confirmed ones for the NASDAQ that didn't mean anything. Now, in fairness, this person might be talking about the Dow Hindenburg omen, which I don't track, but there is not a confirmed Hindenburg omen for the S&P 500. And I was showing those charts, and we never did get one of those. But a potential stock market crash signal on the clock. Okay. Now, a lot of times what these perma-bears will do is we have a 1, 2, 3% decline. They call that a crash. A crash is when we go down 20, 25, 30%. Not a pullback, not a decline, not even a correction. They like to label these things as crash because they're trying to scare people and get more viewers and trying to get people to do things ahead of time. If you listen to these folks, you're already going short right now and you're losing lots of money. Okay, that's what makes me angry about this. When if you just take a little bit of extra time, focus on the charts, see what's really developing. Yeah, we know these things are there, but we don't need to start freaking out right now. We'll freak out when the time comes. Patterns are completing, a rising bear wedge, which I don't believe in anyway, mainly because of these guys. Because this guy's been saying this for 20 years. And this rising bearish wedge, yeah, it just keeps going up and up and up and up and up. Okay, and then Elliott Wave, my goodness, that is something I just don't buy into at all, because you have to come up with your own ideas as to what are the wave counts, and they inevitably are negative. And this is where I get kind of angry about this, that there's a lot of really bad information out there, and people buy into that. They set themselves up for that, and they wonder why their portfolio is going down in value. Okay. Now, I'm a realist. This stuff may end up playing out at some point in the future, and we will position ourselves accordingly. And that's fine. We'll play into that. We'll go with whatever is happening. But to take this as it's happening right now with these general statements that haven't even proven themselves yet, and set yourselves up in that way, that's dangerous. That's foolishness. Now, the only thing I do agree with is the last statement. Bearish divergences are all over the place. Yeah, we're seeing that. I do agree with that. I've been pointing that out for a couple of weeks now, but it isn't impacting the price of the S&P yet. It will at some point, possibly, and we'll just watch this day after day and then go from there. Man, why did I get on my soapbox? Maybe I had too many burgers on the 4th. All right, here's our intraday chart. We did have a higher open, and then we just chopped around as the market was a little indecisive about what it wanted to do. Finally, we got up to R1 initially and came back down to the unchanged level, but this level held. We tried to break a little bit lower, but that wasn't happening. We got back up to R1 again, and this time we went through it. And we chopped a little bit sideways, got above R2, and then ended up closing pretty much at the high. R3 was way up here, so I didn't put it on the chart. Here's our intraday look at the SPY, where there was some initial positive reaction to the employment situation report, but then that quickly came back down, and then we went into the cash session after that. We're still looking good when we look at intraday growth versus value. Okay, the blue line is above the red line. We're also looking pretty good here with the ratio of growth to value for the S&P intraday. That is really showing some strength here, and has been. We saw a little bit of weakness here about a week or so ago, but this has been bouncing back up. So that's looking solid. Our end of day chart, growth was up 1%, where value was up, but almost unchanged. With the mid caps, growth was down, but down less than value, and it was also down less for the small caps. So when we look at our end of day charts, a little bit of an improvement here with small cap growth to value, but nothing that's really helping the market right now. A little bit of a tick up with mid cap growth to value, but nothing that's really breaking out. Where we're seeing an improvement is S&P growth to value. This is breaking out and looking more solid for the time being. Also, between our two ETFs, this ratio just continues to go up, and that's looking quite positive at this time. We just don't know how long this is going to last. Discretionary, it was up a little bit here, but just not really doing all that much. But staples has been what has been declining, but we did see the ratio actually go down in Friday's session. Large cap growth setting all-time highs. Large cap versus small cap setting all-time highs. The Wilshire setting an all-time high. Looking at our trend. Now, this one's looking okay for right now. The ADX is going up above the moving average, and the green line is going up. That's a positive trend, and the red line's going down. Where we're getting a little bit of concern now is we're getting above 40 with our shorter-term ADX chart. And then what's going to cause a little more concern is if the green line goes above 40. So that could suggest in the short term that we're looking a little extreme positive right now. Now, we could still go up from here, back here in November into December. Man, we just went all the way up to 60. So this does have more room to run if we're going to see more upside, but we just want to be aware of this. We did drop off with volume, not a surprise on a day in between holidays. Sentiment not really changing with the Ulster Index. The reason why we don't see a lot of changes, if I remember correctly, this index was really created for mutual funds, and you can only go long and you can only use closing prices. So that's why we see this pretty much going sideways at times. Latest reading from Investors Intelligence came in at 3.73, above 3, but we get a little more nervous if we get above 4. And we actually went up with the VIX. Even though it was an up day, might have been some pre-weekend hedging going on here. We went up on a closing basis. We came and closed pretty much at the high for the bar here, but we're still below the moving average. Both of the sets of moving averages here, but it's still very low readings overall. And with the update, we actually moved up a bit with the VIX of the VIX as the VIX went up itself with the bar chart and the line chart. And so the momentum of the VIX is starting to turn back up. Now, this is a little surprising to see the VIX go up on an up day, but when you look at the climate now, you can't really blame people for hedging their positions. And the 5 period is just barely starting to tick back down now. I've dropped using the 1-day chart. It takes so long for that to update. And I've actually found the 5-day chart updates before the 1-day chart. Figure that one out. Okay, the volatility risk premium, after giving us a really high reading, is coming down, but we're still showing that this is kind of contradicting what we're seeing with the VIX. We're seeing an awful lot of volatility risk premium in the market right now. This fear gauge ended up declining. Our other fear gauge went up. So we're seeing a bit of contradiction along those lines as well. And from what I could tell, I didn't update this for Friday's video because I thought the chart hadn't been updated, but it turns out there was really no change in the American Association of Individual Investors survey. The bulls dropped down and the bears picked up a little bit, but it was the neutral category that kind of expanded, and that's why I really didn't see a change in the latest survey here. But this is one of the negative divergences that we're seeing. We were actually slightly down with the advanced decline line based on price. We're going up, but we were flat in Friday's session based on volume. And new highs, new lows. Still looking pretty healthy here, but not really breaking out, even though we're setting new all-time highs. We're going sideways with the 5 period. We're declining with the 10 period. One of the internal measures that's causing us just to be concerned right now, something to be aware of. We'll wait to see if it's confirmed with price. We're looking negative here with the advanced decline ratio. Both the blue line and the red line are negative now. This is looking positive and maybe starting to get a little too positive. The accumulation distribution is above the moving average and going up. When we take the boom indicator, which measures the distance between the indicator and the moving average, we're starting to get above the 100 level. Nothing magical about that, but when we get up to this level, sometimes that means a level of exhaustion. And we're actually still declining here with the Chaikin money flow. Yeah, we were up. Well, we actually declined a little bit, but we are positive overall. But the moving average continues to go down. We're still going up with the Chaikin oscillator. So our smart money indicators are giving us a little bit of contradiction now. But when we look at the NYSE cumulative advanced decline line, we were actually down in Friday's session. The broad market just didn't participate. And we're still above the moving average with our regular NYSE advanced decline line. This other NYSE advanced decline line ticked down slightly, but it's still positive. When we look at the common stock on the NYSE advanced decline line, we're just kind of chopping around now and going a little bit higher, but we ticked down slightly based on volume. This is where we're looking a little more positive. The cumulative price on the advanced decline line for the S&P, we're just chopping sideways, even though we're setting all-time highs. That means there's just a few stocks that are participating in this, but we're holding up better when we look at this based on volume. And we compare the S&P with the NYSE advanced decline line. The S&P is going up. The advanced decline line is now going down. That's another negative divergence. And we're not seeing any real strength here with our advanced decline line studies. We decline with the NYSE common stock. We're right on the moving average again with the S&P. The mid caps and small caps are declining below the moving average. So these are the negative divergences we've been talking about. And we're coming up to this pivot point. This could be acting as overhead resistance. That's pretty much where we topped out for the time being. And we dropped to below average with volume there. The Stochk RSI is starting to get extreme positive, as is the Williams percent R. It's been that way for a couple of days. The CCI 14 is getting really extreme, and the CCI 20 is also extreme. And our stochastics are extreme across all the different time frames that we break it down into for the short-term time frame. But we're looking good here. When we just look at price and we just look at moving averages, everything looks hunky and dory at the same time. We're above the lines, and the lines are going up with our 20-period double and triple exponential moving averages. But when we look at the 20, 50, and 200 exponential moving average of the S&P, we're going down. The force index, though, is looking good, and we've crossed back above the midpoint, so that is positive. And here's another moving average, just looking really good right now. The 20 period, we're well above both of those. If we start to fall, this will be kind of the first layer of defense. And we're up into the +3 channel for standard deviations. We're getting a little far away from the 20 period moving average, according to the boom indicator. Also from the 50 period moving average. We're still looking positive here with the distance away from the 200 period moving average. Intermediate term, the balance of power, we're coming right up to this line. Now, again, I always like to remind folks, I put these black lines on here as visual reference points. It doesn't mean, oh my God, head for the hills. We're going into extreme land here. It just means we're going into that land, but it doesn't mean freak out now. It just means be a little more diligent with what you're watching. But we're still looking positive with the go, no-go system. On a trending basis, we're looking really good for the S&P. The highest I value is also looking good. And this is encouraging. The TTM squeeze is starting to go back up and turning from a darker blue to now a lighter blue, and that's more positive. And when we look at our 50-period double and triple exponential moving averages, we're above both the lines. The red line's going up. That's the triple, and it goes faster. And this is looking solid for the intermediate term. The CMB composite going above this arbitrary black line now. The ease of movement did tick back up and is still positive. The Arun is going up and not necessarily extreme. We're above 0, so that is positive with the oscillator. But here's another negative divergence. The S&P McClellan oscillator actually came down and we're below 0. That's negative. So we continue to decline with the summation index based on price. However, we continue to turn back up with the summation index based on volume. That could be a leading indicator for us, but we want to just respect it for what it is, realizing that sometimes this indicator is not always right. We came down a little bit, but we're still positive with the broader market when we look at the NYSE McClellan oscillator. So we're starting to turn back up based on price and just barely ticking back up based on volume. We're showing some improvement here with the Swenlin trading oscillator based on price, but we're still negative, or we're positive and showing a little bit of improvement based on volume. More of a contradiction here. The momentum oscillators, they're not sure what to do right now. The PMO's trying to turn back up. We're still declining on the moving average based on price, trying to turn up and just barely crossing above the moving average based on volume. So when we look inside of the S&P and do a bunch of PMO studies, we're declining just a little bit with the PMOs that are rising. The buy signals continue to go down. We're flattening out after declining with the PMOs that are above 0. But we're positive when we look at the Elder's Impulse system for the S&P. We're back to positive for the second day now with the parabolic SAR system. And here's our momentum oscillators, getting kind of confused right now. Still negative, but starting to turn up with the slope oscillator. The MACD is trying to cross back above its moving average. So we're getting kind of a mixed picture here. Turning back up with the slope. The TSI is still positive, so we're switching back to positive in the short term. The MACD is crossing back above its moving average. The PMO and the PPO also starting to go above. So we're switching back now on a momentum basis in the intermediate term, where we're right on top of the moving averages here in the long term with the tricks in KST. We're above all the plotted moving averages here on this chart. But this is another negative divergence. We're setting all-time highs with the S&P, and the bullish percent index is pretty much doing nothing. And the NYSE bullish percent index just barely ticked below 50. That's 49.99. That's about as under 50 as you can get and still be close to the middle there. But the NASDAQ 100 bullish percent index, even though it was flat, is still above 50. The money flow is dropping below 50. That's negative. The ultimate oscillator is going up. That's positive. The vortex still sees the green line going up, so that's positive. And we're extreme positive with the RSI 14 and 9 period. The unbalanced volume is above an advancing moving average. But inside the S&P, those stocks above their 20-period moving averages declined when we're setting an all-time high with the S&P. That's negative. So we're not seeing much of an improvement here with our 20-period study that we do. We also declined with those stocks above their 50-day moving average. That's more intermediate term. We're dropping further below 50 with the 100-period moving average study. That's negative. And we declined with those stocks above their 200-day moving average. So the internal strength is just not there right now. It's a few of these stocks that are really doing well and pushing the indexes, or at least the S&P and NASDAQ 100 higher. The Copic curve continues to be negative. The Pring bottom fisher is still generating a buy signal. We're getting extreme positive with the Sean trend meter. And we're just on the line here with the percent B. Because we were going sideways for so long, so the Bollinger Bands started to get a little bit closer to each other. So we have a little bit of an up thrust, and we're just on the verge of being extreme positive with the percent B. We're just barely positive here. We're seeing a little bit of improvement with the Amex, NASDAQ, and NYSE. We're minus 25, but that's an improvement of where we had been for a broad market measure. And this is looking good. The weekly chart of the S&P, for 3 weeks now, we've closed above this R2 level. Excuse me. So we're looking pretty good here. And we're breaking out above this 50% fib extension level. And it looked like we were having a really difficult time doing that. We broke above it and closed above it on Wednesday, and we just continued that on Friday. We're looking great still on a trending basis. The Heiken Ashi is positive. The Kagi is pointing up in black. That's positive. The Renko is positive, and the 3-line break is positive. And we're still seeing these longer-term negative divergences with our 150 and 200-period moving averages, even though the S&P is setting all-time highs. And we're negative with the mid caps and small caps in the short term. Everything else is positive, where we're still negative with bonds based on price in the long term, and the dollar has now gone into a short-term downtrend. Still positive with the decision points scorecard. Everything is positive there. Seeing a real mix here where we saw the S&P set a new all-time high right out of the gate. Then it set a 4-year high. Okay, so we're looking pretty good there. The dollar, that's why you see this is red. That actually helps stocks. It dropped below 105. We did see a BPI cross below 50 with the NYSE. That's what I showed at 49.99. And then it got back above, but then it ended up closing below again. Utilities coming down after seeing some strength. Tech is also showing a little bit more strength. Discretionary, we want to see that area doing better, but the BPI crossed below 50. And the sectors, we had communication and staples doing the best, and healthcare, another defensive area we're watching. Discretionary, we want to do better, even though it was up. Where we saw energy, industrials, and financials actually being down. Looking better here with our NYSE new highs minus the new lows. We're still above 0 with the raw score, and it's a little hard to see, but we could be starting to turn up with the 50-period moving average of the daily chart. But we're not seeing an awful lot of strength here with the S&P to the equal weight S&P. We're going back and breaking out above these previous highs. This is what we were seeing at the real up thrust back in 2020. Is this going to be a problem at some point, or is it just going to keep going? The Dow's has pretty much been chopping sideways. It was up a little bit. It's still above its 50-day moving average and still above this pivot point. We've switched from neutral to positive with the diamonds. The NASDAQ, this is encouraging. We closed above this R1 level. These pivot points are pretty important when it comes to the NASDAQ. And the fact that we closed above that is a good thing. And we're seeing a close above the R1 level here with the NASDAQ 100. The Qs remain positive and are setting all-time highs as well. We've switched back to positive with the momentum for the NASDAQ 100. We're crossing back above the moving average. And we're breaking out above this 38.2% fib extension. This isn't a fib retracement. This is an extension. And after having some overhead problems here, we are showing some improvement. Small caps just not really doing much. They were down 0.73% and just going along their 2024 range. They've gone from being positive to negative with the Elder's Impulse system. And when we look at the Russell 2000 small caps dropping below 50 with the RSI, still below the 50-day moving average, longer term uptrend. We're trying to turn over here and look positive with momentum, but Friday's action isn't going to help that. And the mid caps just continue to not really show an awful lot of strength below their 50-day moving average and below this pivot point. And we've gone from being neutral to negative with the mid caps with the Elder's Impulse system, setting an all-time high with the total US stock ETF. Apple just screaming up here, doing really well these days. Tesla just bounced up. Can you imagine shorting it in here, thinking that this was just going to go into the toilet? My gosh, we've seen what, a 10, 12% jump in Tesla. It's still in a downtrend, but it's above both of the moving averages and is seeing a little bit of life these days. Nvidia was down almost 2%, really didn't participate in Friday's up move. Microsoft setting a new all-time high, Meta setting a new all-time high, Amazon new all-time high, Google new all-time high. Sound like a broken record. Netflix not in an all-time high, but was up over 1%. The FANG index new all-time high. Financial sector was pretty much unchanged, still above its 50-day moving average. And the staples to tech ratio continues to decline. That is positive for the S&P. The dollar is starting to decline. It broke below 105. Now it's into the 104 range, but it's still in an uptrend as measured by the moving averages. And we're seeing a stronger correlated relationship between the S&P and the world index. It's getting stronger in the short term, still declining with our 50-period correlation. We look at the staples sector, it was up over 1%, bouncing up off of its 50-day moving average, but we're turning down a little bit with the momentum, and the relative strength was flat. When we look at the ratio, the utilities were still below their 50-day moving average, still looking positive with the momentum and trying to turn back up with the relative strength ratio. And real estate just kind of chomping along here, but still in an uptrend. Energy just cannot get above that 50-day moving average. Came right up to it and then closed down from it. We did decline with the 10-year yield, and that really helped stocks. So the 10-year based on price did go up. We're still going up here with our ratio, suggesting that the market thinks we're going to enter into a soft landing. This is an inverse of that same chart, showing how bonds are underperforming, which is positive for stocks. We're seeing a little bit of a shift here. We were a little bit concerned with this 1 to 3 month T-bill ratio to 3 to 7 year bonds. It was going back up. It hit this moving average. Now it's starting to come back down. But we've been bouncing around in here like bumper cars. We want to see this really continue to decline and eventually see this ratio show a death cross. That would be more positive for stocks. But when we look at the S&P 1500 and compare it with short-term bonds, stocks are just continuing to outperform. Another broad market measure with 3 to 7 year bonds shows stocks are outperforming there. Tips to the 7 to 10 year, we were getting concerned as this was going back up. Now it's starting to come back down. Again, this is another one that we want to see this falling for interest rates to be more friendly for stocks. And 1 to 3 year bonds compared with 3 to 7 year bonds, getting concerned as we were going up. Now we're starting to fall down. But you can see this whole mishmash within the rainbow. We want to see this continue to fall as well. The Qs are really outperforming 3 to 7 year bonds and just looking pretty solid right now. The tech sector also looking solid to 3 to 7 year bonds. This is a concern and something we're watching. We look at a ratio between home construction and 3 to 7 year bonds. We're coming down to the 250-day moving average. This was a line in the sand back in October. Is this going to be a land in the sand? Okay, a line in the sand this time as well. We're getting really close to that. The Eurozone, they've got their own election issues that they're dealing with, but we are seeing a little bit of a bounce up in this ratio, but we're still inside of the rainbow. And then looking at our growth to value ratio, showing some improvement here with the Q to the S&P, seeing a bit of improvement with discretionary to the S&P, and large cap growth is outperforming large cap value. And the large caps are looking good. We saw a bit of a turn up with the mid caps and small caps, but we want to see more follow through with the other markets. Right now, it's the large caps that are continuing to lead the market. We're looking negative here with our 19-day advanced decline ratio. We're below 0 based on price, but we're above 0 based on volume. And the S&P to utilities ratio continues to go up. That's positive for the S&P. And the Staples to S&P ratio continues to go down. That's also positive for the S&P. So what's our outlook? And this should be for Monday. I don't know with the day off, it gets me all mixed up here. So this is for Monday, July 5th is what we should be seeing. The technicals are positive. We do have negative divergences and we clearly see them. We're just waiting for price to confirm that. And we're also seeing some weakness coming into the market, but we need to see it based on price of the S&P and the NASDAQ 100. We're going to get consumer credit on Monday, and then twice a year, was it Sadie Hawkins or something like that? The Fed chair person has to come and testify one day before the Senate, another day before the House. The first day is going to be on Monday. And that's where any kind of surprises may happen because they're prepared remarks. Then we watch the Q&A because they try to trip him up and ask him tricky questions. The second day won't be as big of a deal. That will be happening on Tuesday, where he'll read the same prepared remarks, and then we watch the Q&A to see if anything happens there. We want to keep an eye on all the crazy things that are going on around the world right now. It's more focused on what's happening with the U.S. election, as well as the British election's already finished, but there's still more to come with the French election. Here's the economic calendar for the upcoming week, consumer credit. And then, okay, was I incorrect? I guess Fed Chair Powell testifies on Tuesday and Wednesday. That makes more sense. That's usually what he does. Other than that, we're not going to get any economic reports on Tuesday. And then we're going to get more testifying here on Wednesday. And then we're going to get CPI on Thursday and PPI as well as consumer sentiment on Friday. Yeah, I guess it is Tuesday when he's going to be talking. All right, seasonality. We're neutral to positive for July 8th. So not really much of an edge there with a slight lean to the positive side. We're coming into not anything all that drastic here during an election year. According to the Stock Traders Almanac daily chart, it'll be the 5th trading day of the month. Monday is the most positive day. You're going to get folks who finally get over their hangovers for the 4th and look at the price of things and say, let's buy some stocks. And maybe that will lead to a positive open on Monday. And then I'll probably drop this here pretty soon. This is a longer term look. We're through June. We're coming into July where, yeah, we don't go straight up, but we do see a real positive seasonal trend during the 4th year or during an election year. But we're also watching this. This is the NASDAQ, where it tends to do really well for the first part of NASDAQ. And so far, it's living up to that. But it doesn't last forever. The party's going to end at some point. And we're getting way far away. Even though I haven't updated this yet, we're getting into July now. We're getting even further above this average that we usually see of what happens when the sitting president is running for re-election. And of course, there's a whole lot of speculation about that right now. And then we look at the first half of July, which tends to be really, really good, and the second half of July, which tends to be okay. So we want to at least be prepared for that on a seasonal basis. The warning signs, we're still keeping an eye on staples, utilities. We don't know if energy is defensive or offensive right now, and healthcare. We're still seeing that weakness with the advanced decline lines. The growth to value ratio for the S&P is actually doing quite well, but not for the mid caps or small caps. And discretionary to staples, it's not really doing all that well these days. We have both the NYSE and S&P McClellan oscillators, as well as the summation indexes. They have now both gone over to being negative. The Swenlin trading oscillator, it's negative but improving. So we're looking better based on volume, but negative based on price. The oscillators, they're turning more negative, but could be starting to switch back over and look a little more positive. The bullish percent index for the NYSE is dropping below 50. The money flow is negative, and the Copic curve is also negative. Then we have our smart money indicators here. The accumulation distribution looking really good, maybe a little too good. Chicken money flow, not seeing a lot of strength with that moving average. It's still declining. Chicken oscillator still looking positive. The parabolic SAR is positive. The bullish percent index, we're above 50, but it's just not going anywhere. The 5-period equity put call ratio is now back to going down. The ultimate oscillator, the vortex, those are positive. The Pring bottom fisher, buy signal. The financial sector is still positive, and both the momentum and the bullish percent index for the NASDAQ 100 continue to be positive. So our conclusion, we're positive, but we're seeing this developing weakness that at some point the market's going to have to deal with by either going down with the indexes or seeing the broader market show more strength. In the short term, we're positive and becoming even a little bit more overbought. We're becoming more overbought in the intermediate term, and we're seeing this weakness with broad strength inside the S&P, not really showing up right now. But we're still positive in the long term, but we're still seeing those negative divergences between the 150 and 200 period moving averages. Thank you. I hope you have a wonderful weekend. I'll be putting out the usual weekly videos. So have a great weekend, and I will talk to you in the next video.